Well, here we are at the 17th Annual Income Property Lending Conference here in Long Beach, California. It was one of our most attended conferences in years. One of the highlights of today's event was the Commercial Real Estate Broker Panel, where we had leaders in the field of multifamily, industrial, retail, office, and hospitality speak on various aspects as far as what's happening in the market today.
I'm very pleased to be the moderator for this lunchtime panel. We do have some great panelists today. Lee Black, we've got Chris Mailing, Brad Luster, Alan Reay, and then Laurie Lustig-Bowers. We're going to get to that.
Deals that are getting done. I thought I'd run through some of the concessions that we're still seeing. It's still a tenant's market for the most part. That's still about a month of free rent per term, per year of term of lease. Some are doing twice that to keep their face rates higher. Generally speaking, there's a negotiation room of maybe 10 to 15% off of asking rates. The typical TI allowance we're seeing is anywhere from $25 to $35 a foot. Again, someone may throw in 40 or 45 to keep the face rate a bit higher. We actually just did a deal in Warner Center where we negotiated with the developer for ground floor office space, second generation, a really nice project. And we had a nice TI allowance that was very high. We had a lot of free rent, and we had parking concessions. At the last minute, as we were drafting leases, the lender came in and said, timeout, start over, no free rent, no TIs, we'll just cut a check to the tenant and just start the lease at the rate day one. So that was an interesting twist about 3 months ago.
I'm going to go to Laurie. And both you and Brad mentioned that the real estate markets are looking hot. The hottest market, Brad said, in the industrial. You said frothy, which is music to an economist's ears. Didn't we just have some sort of a Great Recession and a financial crisis? Did we develop a case of amnesia? What's behind the froth? Why are people doing this? Any sense, Laurie?
I really think the primary reason that we're seeing it being so frothy right now is really due to how cheap debt is for apartment buildings today. That is putting a lot of pressure on the cap rates to come down because it's getting very competitive. And as I mentioned earlier, we're seeing 7-year fixed at 3.75%. I have clients that have special relationships with their banks that are borrowing closer to 3%. And I think when money is that cheap and the terms are getting pushed up, where we're seeing them, I mean, if you're talking about agency financing, obviously they're going to look for a 1.25 debt coverage ratio, so that therefore people would have to come in with probably 50% down. But in some cases, I mean, they're able to get higher LTVs than that with really low interest rates. So that's driving the ability for people to pay some pretty significant prices for these buildings.
So we've gone from $550 million in sales in California in 2009. Last year was a record year in sales transactions that we've been tracking for the last 16 years. $5.4 billion worth of hotels traded last year. So 3 out of the top markets in the entire country for hotel sales are in California. So New York was number 1, followed by San Diego 2, San Francisco was 3, and Los Angeles. So we've really seen a huge rebound.
Looking at multi-tenant retail, I think if you're infill in supply-constrained markets, such as West LA, parts of the South Bay, even in downtown and the San Fernando Valley, no matter what happens in the economy, if it's good real estate, it will always be good real estate. Maybe you have some rollback on rents, but we're seeing huge velocity both from the buying entities looking to acquire more real estate and from the tenant side. It's very, very comforting. However, when you go out into the secondary and tertiary markets, and I'll give you some perspective on that. The Antelope Valley, Palmdale, Lancaster, Victorville, Hesperia, Apple Valley, and even parts of San Bernardino and Riverside County, Coachella, and I'm not talking about the concert, I'm talking about the whole valley out there. It's pretty distressed. And you see a lot of pain. And there is certain statistics that we're compiling now that the amount of retail that's been built in those markets will take about 7 to 10 years to backfill. And that is just existing stock. And so you're not considering the other issues that are impacting retail, which I think we're all aware of how the internet has impacted bricks and mortar retailing. And I'm referring primarily to the showroom concept, which we've been hearing about with Best Buy. People go in, utilize salespeople's time, kind of touch the merchandise, and then in the store whip out their iPhone and buy it on Amazon and actually show it to the guy and say, thank you, see you later.
Requirements per office employee are being reduced, say, compared to 20 or 30 years ago. Do you have a feel for that?
Yeah, it's happening, and it's happening on a more regular basis. Again, I think people are trying to be more efficient. They're trying to save money on the amount of square footage that they lease in their portfolio. Whether you called it hoteling years ago or telecommuting, or now it's creative, flexible, collaborative space. The issue is to drive the square footage down. Renewals, renegotiations, generally speaking, if it's the same group, same amount of people, they're downsizing their square footage. On new projects coming in, they're looking for more open, flexible, collaborative type of environment, and the ratios are going much higher on the parking, which is an issue for suburbia because we don't have a lot of parking, and we don't have any public transport really to allow people to carpool and use public transportation, but that's just one of those things we're working through.
I'll just share this with you. In the go-go 2000s, we'll call it, there were 360 projects that were entitled for adaptive reuse or new development in the downtown area, and only 18 of those projects were completed. So if you're a broker, make the money now because high hopes and dreams don't always come true. We have zero debt in our portfolio. Fortunately, many of our clients are casino gamblers, and that's what keeps our industry going and our business running. But this will be a banner year for major properties and pretty much anybody in our industry, in our marketplace.
We have every lender that has spoken today is going to tell you exactly how they can structure a loan. There are 17 loan transactions that are going to be presented to them, and in 1 hour we're going to underwrite them and quote them to everybody in the audience. So we look forward to seeing you there, and then the cocktail party. Thank you for coming, and thank you for being part of the conference.